What if the institutions responsible for keeping the global financial system stable are quietly preparing for that very system to fail? This is not conspiracy, and this is not speculation pulled from the fringes of the internet. This is what the evidence suggests when you look at what central banks around the world are actually doing, rather than what they are saying in their carefully scripted press conferences. Right now, at this very moment, the most powerful monetary institutions on earth are taking actions that only make sense if they believe something catastrophic may be approaching. And the speed and coordination of these preparations is raising questions that deserve serious answers. Let us start with what is actually verifiable and documented. Central banks globally have been purchasing gold at a pace not seen in over 50 years, according to data from the World Gold Council. Official sector gold purchases have shattered records in consecutive years, with no sign of slowing down. China, Russia, India, Poland, Singapore, and dozens of other nations have been aggressively adding physical gold to their reserves. This is not normal portfolio rebalancing. This is preparation. When central banks buy gold at this scale, they are hedging against a scenario where paper currencies and digital financial instruments cannot be trusted. Gold has no counterparty risk. It cannot be frozen by sanctions. It cannot be printed into worthlessness. And the fact that so many central banks are reaching the same conclusion at the same time tells you something important about what they see coming. The Federal Reserve has been conducting stress tests and liquidity exercises that go far beyond routine regulatory requirements. Reports indicate that the Fed has been modeling scenarios involving simultaneous failures across multiple systemically important financial institutions. These are not theoretical academic exercises. These are operational preparations for crisis management on a scale that would dwarf 2008. Sources familiar with the matter suggest that the Fed has been in close coordination with the Treasury Department and major Wall Street banks on contingency protocols that have never been activated. The Bank for International Settlements, often called the Central Bank of Central Banks, has been issuing warnings with increasing urgency about hidden leverage in the global financial system. Their reports point to trillions of dollars in off-balance sheet derivatives exposure that is not captured in standard risk assessments. This shadow financial system operates beyond the reach of regulators, and when it unwinds, it tends to do so violently and without warning. The fact that the BIS is publicly raising these concerns suggests the risks have grown too large to ignore. Across the Atlantic, the European Central Bank has been taking its own precautionary measures. Reports indicate that the ECB has been running war game scenarios involving the collapse of major European banks and the potential fragmentation of the Eurozone financial system. These exercises have reportedly included simulations of bank runs, capital controls, and emergency currency interventions. Officials have publicly downplayed these activities as routine, but the timing and intensity suggest otherwise. Now consider the political context. Amplifying all of this financial stress, the ongoing legal and political battles surrounding Donald Trump have created a level of institutional uncertainty in America that reverberates through global markets. Foreign central banks do not view Trump simply as a political figure. They view him as a signal of American systemic instability. The possibility that a former president could face imprisonment while simultaneously running for and potentially winning the next election creates scenarios that no financial model can adequately price. Sources suggest that several Asian and Middle Eastern central banks have explicitly cited American political risk in their internal assessments, justifying accelerated diversification away from dollar assets. The Federal Reserve itself is navigating an impossible environment. Inflation remains above target, but the financial system is showing cracks that argue for easier policy. Every decision Powell makes is now viewed through a political lens, with accusations of influence coming from all sides. This erosion of perceived Fed independence is itself a destabilizing force, because markets depend on believing that monetary policy is driven by economics, not politics. When that belief wavers, capital flows become unpredictable, and crisis probability increases. The treasury market, the foundation of global finance, is experiencing dysfunction that would have been unthinkable just a few years ago. Liquidity has deteriorated, meaning it is harder to buy and sell large quantities of treasuries without moving prices significantly. This matters because treasuries are supposed to be the safest and most liquid asset on earth. When that market shows stress, it means the plumbing of the entire financial system is compromised. Reports indicate that the Treasury Department has been considering emergency measures, including buyback programs designed to stabilize the market. These are tools typically reserved for crisis periods, not normal operations. The International Monetary Fund has been quietly updating its emergency lending facilities and crisis response protocols. Sources familiar with the IMF suggest that internal discussions have focused on scenarios involving multiple simultaneous sovereign debt crises, triggered by a combination of high interest rates, currency instability, and political dysfunction in major economies. The fund has reportedly been pre-positioning resources and negotiating standby arrangements with vulnerable nations. This is not routine maintenance. This is preparation for systemic stress. What makes this moment particularly concerning is the coordination. Central banks typically operate independently and jealously guard their autonomy. When you see institutions from Washington to Frankfurt to Beijing to Basel all moving in the same direction at the same time, it suggests a shared assessment of risk that transcends normal policy disagreements. They may not agree on politics, they may not agree on trade, but they appear to agree that the system they collectively manage is more fragile than the public understands. None of this means collapse is imminent. Central banks have enormous tools at their disposal, and they have demonstrated repeatedly their willingness to deploy those tools aggressively when necessary. But the fact that they are preparing for worst-case scenarios at this intensity level tells you that the people with the most information and the most power are worried. The gap between public reassurance and private preparation has never been wider, and somewhere in that gap lies the truth about where this system is actually heading. The question is not whether central banks are preparing. The evidence confirms they are. The question is what exactly they are preparing for, and whether the rest of us will find out before or after it is too late to do anything about it.